So the Fed, in first time in 4 years, lowered the federal funds rate by 50 basis points, meaning 0.5%, right? And okay, so what does that mean for the average American? Not much, really, honestly. But the Fed said inflation numbers are coming down to their target levels of 2%. Economy is still strong. Unemployment still good. So, but however, there's going to be more cuts. I'm like, okay. Well, the market's forecasting that by the end of 2025, interest rates are going to be lower by 2 percentage points than what they are today. So will they keep cutting 0.5% at a time? I don't know. That's not the point. The point is long term, by the end of 2025, the Fed funds rate futures are forecasting 200 basis points, meaning 2 percentage points on interest rates. Now, 0.5 point, will it initial impact immediately will be in the housing, in the mortgages, okay? I can already see 30-year mortgages down by 0.5 percentage point, okay? Will it matter to car loans? Yes. Will it matter, will it matter to your credit card balances? No, not as much, because banks raise rates immediately when the Fed starts raising rates because they are borrowing from the Fed most of the time, right? So if they're borrowing at 5%, they're going to have to sell it to you, put a margin of 300 basis points, probably sell it to you at 8.5 or 9. And if you're subprime, probably 12s and 13s and 15s. Will they cut those rates right away? No, but there's always a delay. But then big banks started cutting the prime lending rate as well. So with a day or two delay, but short term, immediately, there'll be a housing effect. Mortgages, 30-year mortgages or whatever mortgages you're looking at to buy a house. So that will create some housing activity because affordability on housing has been dead. And major part of it was because mortgages went up from 3.5% to 4% on 30-year fixed to 7.5%. Well, now, slowly, every time the Fed cuts, those mortgage rates will start coming down. So the forecast is 2 more percentage points. So meaning 30-year mortgages could come down to 5.5% by the end of 2025. And it's a good thing, right? But my point is, why does Fed cut rates? Fed never cuts rates when they don't see trouble in the future or a slowing down economy. However, what Jay Powell said during his news conference after the decision is completely kind of contradicting this. So I saw this tweet, and this is an amazing technical analyst, actually. He's on Twitter by Sven Henrik. So I'm on Twitter. It's in the show notes. You can go follow me on Twitter, but you can follow these brilliant minds on Twitter as well. And so he's kind of comparing. He always compares. He always looks back in history. Now, does history repeat itself all the time? Sometimes it does, sometimes it doesn't. But I thought this was valuable info for you guys. So he's comparing what happened in 2007, right before the great financial crisis, to today. Are there a few similarities? Yes. Are there differences? Very much so. But that's why we have a market. Some people think it's going up, some people think it's going down, and market gets created, right? Because if everybody was saying market was going up, there's nobody left that says the other side to take the other side. There'll be no sellers left, right? But Sven says September 18th, 2024, 50 basis point rate cut. September 18th, 2007, 50 point basis cut. Okay, rate cut. Then he goes, for the claims, it's different this time, which I'm kind of saying it's different this time because, that was right before GFC, Great Financial Crisis. I mean, I was in the mortgage business. The mortgages I was doing, I knew they were trash. And I'm still doing it because if I don't do it, Countrywide is going to do it. If I don't do it, Washington Mutual was going to do it. So I'm like, hey, I'm guilty as charged. But long story short, he's saying that for claims, it's different this time. You are correct. He's being facetious there, I think. In 2007, debt to GDP, which I have talked a lot about, was 64%. The deficit was 1% of GDP, and the market capitalization, total market capitalization on stocks, was 107% to GDP. Okay. Now, debt is 122% of 122% of GDP. Okay, this is true. I've been talking about this. Our debt is at 35 trillion. Our GDP is 27 trillion. That's about 125% actually of GDP. Alarm bells have been going on in my head for like 6, 8 months, a year now. I'm going like, this is unsustainable. And the debt is going up $1 trillion every 100 days. So that 122% is going to be 125, 128, 130. And if we do get a slowdown, because Fed is cutting rates because they're anticipating a slowdown, maybe not a recession, but definitely a slowdown, while the GDP is going to shrink from 27 to 25, while the debt is going to 35. See what's happening here? GDP is going down or shrinking due to slowdown. In a recession, God knows what will happen to the GDP. We may go negative. But then the debt keeps going up, irregardless of what happens to the economy. So that debt to GDP can keep going higher. Then he compares it, the deficit is 8% of the market cap of GDP, and the market cap to GDP is 200% now. Meaning, all the numbers in the first sentence, 64 is 122 now, 1% is 8% now, and 107% is 200% now. So he has a point. So I guess he was being facetious. It's really different this time. It's worse, much worse. I did not know these numbers. Now that I'm looking at it, I'm going like, okay, hold on. And that's why community is good. Financial community is great. There are some brilliant minds around, and you just got to follow them. And now, whether this turns into a recession or not remains an open question, and we should stay open-minded. 1,000,000% agree with that one. But fact is, this is a historically very expensive market with a forward PE of 21 and expected earnings growth of 15%. There is very little room for error. That I completely agree. I've been in that actually mindset since I started the channel 3-4 months ago. I think this market is extremely expensive. It's holding on 2 legs of the 4 legs of the table. Again, don't fight the Fed though. Fed's cutting rates. You just got to be careful. But I've talked about the Fed pivot in the past with a video. Please go check that out. I went back like 80 years of the Fed pivot. Every time the Fed pivots, initially the market does reasonably well. And then 6 months later, market is, if we go in a slowdown or a recession, is 30 to 45% lower. And with these numbers, 21 PE, 15% earnings growth, well, if you go on a slowdown, earnings growth is not going to be there. So that PE is going to shrink. You guys got to be really careful with this market if you're pushing on the upside. I mean, hedging at least. Anyway, so there was another tweet that I thought compared 01-07 to 2024, and this is by Geiger Capital. Again, follow this gentleman as well. Last 2 times, again, is history going to repeat itself? This is kind of talking about my Fed pivot. Last 2 times, the Fed's first cut was 50 basis points after a easing cycle. These happen 2 times in history, right? January 3, 2001. S&P 500 fell 39% the next 448 days. Unemployment rose another 2.1%, and it was a recession. On September 18th, 2007, just like Sven is talking about, these are 2 different people. S&P fell 54% the next 372 days. Okay, people, we are at 5,700. Think about it. So it may be time for beautiful DCA action, because through that, if you DCA, dollar cost average, in your long-term portfolio, seriously, 3-4 years from now, you'll be going laughing all the way to the bank. Unemployment rose another 5.3%, and recession took place. And for September, he puts question marks on the chart from Federal Reserve Economic Data. Well, as you guys can see, that's the unemployment rate. And he circled all the time when unemployment rate started to turn up and start going up, right? This is what's happening. Our unemployment rate was down to 3.5. Now we're at 4.3. So unemployment is ticking up, as you guys can see on the right side. That big spike that you guys can see is during the pandemic. So yeah, the similarities are there. Is it different this time? I don't know. I don't think I think it's different, but I don't think the drawdown is going to be to the tune of 39 to 54%. I definitely see a minimum of 20% haircut coming up shortly, probably within the next 3 to 6 months. And I'll answer the questions in a minute. So that's the first topic. So you guys have to start thinking about this. What you're seeing out there yourselves, right? What are you experiencing personally, right? I mean, the average American, I think, has been in a recession for a while.